Welcome Andreas Locher, Michel Miseries, Tugdual Millet, Philippe Rossini, and Valérie Schurmans to talk about lease and contractualization. Welcome, everyone. The first question is for Tugdual. You're here. I'm going to sit. It's going to be easier. You have a strong presence in the hospitality sector. You were one of the first major industry players in France to enter the market through leases. Actually, this is one of your specificity. So can you tell us why and what kept you in this model for so many years?
Well, basically, I would say it was easy to manage, quite predictable, and ensuring us strong development capacity. So easy to manage because obviously leases, fixed leases or variable leases, when you are in front of you an hotel operator that is doing business in your premise, is in charge of everything at the end. So in terms of, I would say, property asset management, it's quite lean with very long-term lease. So no, I would say we were coming from investing in office, in resi, so discovering also the attractiveness of hotel leases was quite straightforward. But it's not just because we are lazy that we wanted to invest in hospitality. It's also because, as I was mentioning, it was ensuring us some interesting development capacity. Because when you enter into a relation with a tenant, so an hotel operator, obviously the first objective of the hotel operator is to develop himself. And being a real estate partner of those operators, so that was at the time, it was Accor, it was BNB, etc. We have directly from them an important pipeline. So we like also the idea that we benefit from an existing portfolio and we have good visibility in terms of development capacity. That's why we started with France, and then with BNB we went in other countries, in Accor, discovering other geography, etc. And finally, I would say we try to be more and more sophisticated in the way that we are investing in hospitality, and we appreciate also the capacity that we have to benefit from a bit of upside. So not only fixed lease, but also lease with a variable component. And then this is the second step. I'm sure we'll discuss after on the third step, which is directly owning the full hotel, so the OpCo and the PropCo. But this is the way we started investing in real estate through leases, and today it's still more than 60% of our portfolio. It was historically 100%, but today it's 60%.
Andreas, I see you nodding. Do you want to add something about what Tugdual just said?
I'm quite impressed. Like 60%, we are standing at 15% as an exposure of hotels, 90 hotels and 7 billion euros here in investment real estate. Good morning. Yeah, well, we've been investing for the last decades in hotel real estate. You know, just remember back like 20 or 30 years, our lease agreements were just having like 10 to 15 pages. So we felt it's so easy. You just buy this hotel and have a contract and put it into the drawer and then pull it out after 20 years. And then you will really experience badly because you didn't take care during that time. So this has fundamentally changed over time. Hotels are not easy because you need to follow them as well, even a lease agreement, not only a management agreement, but lease agreement. You need to be in close touch with the operators. You do also need to do some sort of active asset management and see, you know, is the lease covered. You need to reinvest into the hotel and be close with the hotel, so that you don't experience at the end something unexpected. So therefore, this has changed a lot, and therefore our contracts, the pages have somehow expanded from 10 to 15 pages. I don't know, Valerie, how long is our contracts in Barcelona? Like
I think we're around yes,
something like that. So everything is regulated, and you of course try to reflect all the challenges you were facing during the last years in these contracts, either if it's with regards to FFNE, if it's regards to indexation. What happens at the end of the term? Who has to do what? Extension options. So there are so many aspects you really now are reflected into the lease agreement. You also need to really understand the operation of the hotel behind, even in the lease agreement. Yeah.
Thank you, Andreas. I'm going to let you moderate the panel because you've made a perfect transition for Valerie. So you need to be really close to your owner partner as an operator.
Absolutely. The lease agreements today require a very close cooperation between the owner and the tenant because we both have some skin in the game. As Tugdual already indicated, there is a component which is fixed, there is a component which is variable. At least that's the lease structure that Radisson is able to consider. And for that, you need to work together. You need to work together when it comes to the upkeep of the hotel to make sure that it's a relevant product, to make sure that it stays relevant during the term of the agreement, during the term of all its extensions. So a very close cooperation between those two is essential, and to also have a good understanding while you're negotiating that lease agreement to make sure that you have a long-lasting friendship and to iron out any possible misunderstandings from the get-go. So in that respect, here at Radisson, we have I would say, historical base of doing lease agreements for a very long time. It represents approximately 20 to 30% of our business. So we also went through a learning curve, I could say, almost together with the three representations here during the panel. So with Union, with Covivio, with Swiss Life, we went through that learning curve together, which helps us to negotiate new deals, but which also reminds us of those learnings. So that's I would say that's how we have grown. We have not been able to very proactively enter into lease agreements until 2018. Today, for strategic locations across Europe and across some selective destinations elsewhere, we are able to really consider lease agreements, and it has allowed us to rebuild our portfolio in Europe, create presence in destinations where we were not present, like Italy. I'm thinking France. I'm thinking Spain as well, which has definitely contributed to our successes in Europe since over the past 7 years.
Philippe, did your contract actually went bigger and bigger, talking about these agreements too in Swiss Life?
Yeah, no, for sure. We are first and foremost lease agreement type of investors. We do now a little bit more invest in the OpCo as well, but we have a strong tradition of doing leases. And just to build up on what Valerie and Andrea said, it's important that the alignment of interests, when it's fixed leases, can be a bit less important than when you have variable or when you have interest in the business. And I think COVID was a good example of where that partnership started, continued, or stopped, because the combination of on one side landlords granting some rent-free to allow the partners to be able to keep their business alive, and then afterwards having that partnership compensated in continuing the refurbishment, the development, integrating ESG topic that was less important before COVID. And I think that made the difference where in which type of this contract you want to go further. Doing pure fixed leases contract, you need to have a strong commitment contractually and morally with your partner, because we've had an example where it could go wrong.
Yeah, of course, we all heard about it, but that's not. Let's be positive today.
It is. But I mean, positive thing. Now you have when we do invest in fixed leases with some partners, we are more aligned, and we know who needs to do what more clearly. So no, it's a positive thing, I think.
Andreas, would you like to add something about those conditions regarding fixed leases, fixed base leases, on the way you move? Is this something you are keeping doing, or are you moving to more flexible conditions with your partners?
Yeah, we try to also include some variable lease components. Historically, we've been only on the fixed lease side only. You know, I've talked about like 20 years ago, and we didn't even have the right to look at the hotel numbers or the operational numbers. But, you know, also introducing these variable lease components, turnover based or also profit share concepts, then of course you naturally need to have a view on the operation. So therefore, we also would like to participate in the upside if the hotel is going very, very well, and then also, you know, somehow to a certain extent share the downside. You know, what has happened in the past where you've got high fixed lease commitments by the tenant. If they're making a good deal and having a coverage of 2.0, they never come to us and ask, "Oh, please, can we increase the rent?" So, but the opposite, you know, if for instance in COVID times and the lease were underwater, if the lease were underwater, then they immediately knocked at our door. "Oh, please, could we waive or could we reduce rent?" And there is, of course, we were prepared to a certain extent to do some special arrangements. But, you know, introducing variable lease components and therefore reducing the fixed rental commitment by the tenant somehow, of course, helps in order to be a bit more flexible on that side. At the end of the day, nonetheless, we are open-ended funds. We do need to receive rental income, so therefore a certain minimum amount of fixed rent is important still for us to receive.
To have a little smooth base.
Yeah.
Chuja, do you want to add something?
Well, more or less aligned with what Andrea said. Clearly, we try to avoid pure fixed lease. Basically, what we say and what our investors are telling us is that when you believe in an hotel or location, you want to benefit from the potential upside, and has been the case in different times where you invest in fixed lease and you're stuck with the current contract, even if I would say the situation is improving a lot, even if I would say operation is very successful, and at the end it's a bit frustrating. So that's clearly the case on the fact that, okay, we believe in long-term hospitality trends, so we want to be exposed to that. And that's where there is a change between a pure real estate approach, long-term lease, I would say more bond-like investment, I would say, rather than, let's say, more operating investment, so hospitality investment, where we can benefit from evolution. And when you have also a variable part, then you can share, I would say, performance with your hotel operator. Then you could be more constructive in the way that you can help operation, etc. So in all the negotiations that we can have where we have only fixed lease, we try, not always successful, but we try to add a variable component. And with also the fact that we can accept to lower a bit the minimum guarantee or the fixed part, to improve a bit the variable part.
Valerie, how do you deal with this condition?
As I said, all of our leases are hybrid leases with a fixed and a variable component. This is also because we want to have some kind of business protection for the good and the bad times. We want our landlords to be involved in the assets, as Andreas already rightfully said. The asset management part of the business is much more demanding over the past 10 years compared to before. It comes to reporting, it comes to establishing the renovation, it comes to the cooperation between the landlord and the tenant to establish renovation works and to make sure that the product remains relevant. For that, we have also established a specific asset management department within the company. So from our point of view, to have that component between fixed and variable is essential. There are, depending on the profile of the investor, that a variable component can carry more upside. and a little less fixed responsibility from our point of view. But that really depends on the profile of the investor in front of us. So we adapt our model to the different investors, either they're institutional, private equity, family offices, and the requirements are each time different. So we are in that perspective very focused on maintaining a relevance to the counterparty, which is, I would believe, our ability to stand out within this, I would say, business model.
Yeah, you told adapting to your partner, but also adapting to the hotel, to the facility, location,
to the location,
and
etc.
so on.
The sky is not the limit. The sky is not the limit. I wish, but it's not.
Yeah. Philippe, on your side, are you more comfortable with fixed condition or variable? What is your philosophy on that topic at Swiss Life?
Literally the same thing as Valerie said. It depends on the product and investors. And so when you have a demand from investors, very institutional, who liked a fixed or a security, you will go for more fixed, higher fixed component rather than a variable. So it depends on also the flavor of the moment from some investors, who's looking more for what at what time, and then once you have that, you can find products that fit that strategy. But I would say we're more on the fixed component, but obviously, same as the others, having a variable align more the interest of everyone.
Of course, indeed. And let's jump into the conditions, actually. On what do we index that variability? Is it about GOP? Is it about KPIs, performances, turnover? What is your cooking recipe on those topics? Chukjoal, I see you nodding. You're the first.
In fact, so basically we can find two options when it comes to add variability in the lease. Either it's based on the turnover, so percentage of the turnover, or on the EBITDA after paying the fixed rent, where we can share the excess EBITDA between landlord and tenant. So really, it's a question of negotiation, condition. I would say trust between the two parties. Personally, I'm not a big fan of, let's say, sharing GOP or EBITDA, because at the end, either you're a tenant, you're exposed to the turnover, etc. But having I would say, sharing the EBITDA without having a control on it is a bit difficult, I would say. And probably, I don't have specific example, but sometimes you can have disalignment of interest between landlord and owner, obviously, and tenant. Obviously, it's not a general approach, but being remunerated on EBITDA without having the control on operation, then let's move to directly having the control on operation. But let's say being a bit passive on it can be. We have some example, but the majority is on the turnover. It's easier to control, easier to predict. No, but we have less sensitivity. Obviously, with all that we happened with inflation, etc., we are much better as a landlord to be exposed to turnover than on operating side.
Not to worry, we can do both.
Andreas, Philippe, would you rather add something on that topic of GOP, turnover, whatever?
We've also been doing both, but more with a focus on profit share. I do go along well with the fact that it may be a bit risky. You're not 100% in control, of course. So therefore, we do need to have a very strict reporting as per a uniform system of accounts. We need to follow these very closely, and of course there are many companies which you may not be in trust and really really believe what they're reporting to you. On the other side, as you pointed out, it's a matter of drafting good relationship. For instance, with Radisson, it's positive. We do have the trust and a good relationship that we can rely on the bottom line. It also has the positive effect against the turnover rent that you really go to the bottom line, what's really there and can be shared. If it's on the turnover basis, turnover can be rising, but also the cost side can be increasing even more. So therefore, there could be a mismatch in what's been to be shared at the end of the day. So therefore, from the sharing point of view, it's more direct and more true what you could share. But the controlling thing is of course a challenge which you need to consider. Yeah.
No, the same thing. But even for us, we used to have some contracts. We do have a couple of them. We still have EBITDA-based turnover, variable rent. But when we've been able to do it, we changed it to turnover a couple of times. But it's. I think that's not the right contract to be exposed to EBITDA level.
Michel, leases are not your sweet spots, but it doesn't prevent Marriott from growing really fast on the European market. What is your position on those topics?
Well, we don't do new leases. We do have existing legacy leases. And as you say, we've been growing quite a bit, actually forming great partnerships with owners and investors that do leases. And that's why franchising in Europe, in particular Germany, the Nordics, where leases are so common, is where we form that sweet spot is really there. And the reason for that is that on the franchising side first, that the local operators that are in those markets are best equipped to deal with the local leases in those markets. They complement that with taking a franchise agreement with us. And we have now more than 30 brands. Some of our mid-scale and select service brands actually are super well suited for these guys to predict their long-term cash flows, coverages, and all the risks that you have with a lease. So that's where we form the partnerships. And I would add the third part is, of course, the landlords, like in this case, Andreas, etc. Is to make sure that there is this right balance between, for us, the franchisee and the landlord when you do the lease. And I think when those three things, those three stars are well aligned, I think you can have a very good partnerships. Mm-hmm. So even with management agreements, we still grow with management agreements. In fact, its management agreements grow even further than they ever done. But the franchise piece is the fastest growing for us. So on a mixed basis, it's actually growing faster. And the reason is, again, 4 Points Flex is a brand that we launched. And 4 Points Flex has been an amazing success. We have now more than 20 open in a year and a half. And it's a super flexible brand that allows the local regional players to use their platform to convert the hotel very quickly to our system at a cost that is preset. So you know exactly what you're going into as a tenant, which helps, again, to predict the future and create stable cash flows. And leases, as we know them, it's all about mitigating your risk, right? Because you don't want to have the worst of all sides, not the ownership and not the freehold, just managing the property. So,
Philip, I see you nodding. Do you want to add something on that topic?
I agree with what you do. We usually don't do it ourselves, but that's interesting. The way you the best contract for you. One of the best is the lease. It's the franchise, and the management. You do tend to be selective as well on your side.
Take in a secondary market, right? So if you have a local player who has local connections, employs the people locally, so they are well set up to operate the hotel most efficiently. So even they will take the lease on their side. But what we bring is the top line, is a premium on the top line at a much lower cost of acquisition, plus a lot of other cost benefits. So, and I think that's where the stars are aligned and where we have brands like 4 Points or Moxie, Courtyard, Residence Inn, they perfectly fit. And that's why that's fueling our growth significantly. So we are familiar with leases. We actually do follow them quite a bit because we want to understand the risks that our partners getting into, what their coverage ratios are. And if they're a cover of 2, as Andreas is saying, then I may look at the lease as well, this, Andreas. So, but that's obviously more the exception than the rule. So, but that's really how we look at it. And then we may even help our partners to make sure they're successful with their lease, especially in the first couple of years, to set them up and going and grow more units so they can further mitigate their risk if they have a portfolio, where one helps or offsets the other. So,
Yeah, talking about portfolio, Valerie, do you have local partners that you back up with your expertise at Radisson?
Well, we definitely have local partners, like Michelle is indicating. We have local partners in various countries, sometimes pan-European, who support the franchise growth. We help each other. They take the position on the asset. We come with a franchise contract. So from a Radisson point of view, franchises in Europe represent approximately 40%, while leases and management agreements are approximately 60%. So for 60% of the assets under our flag, we are responsible for the full P&L, which makes us also a relevant operator because we have that exposure of looking at every line. But either we have the local partners to act as white label operators to grow that part of the business, or we have strategic partners as landlords with whom we have multiple units, as you see the gentleman sitting here today.
Andreas, you have both elements, well, the three elements in your portfolio. How do you arbitrate? Is it about the hotel, about the partner you have? How do you balance all those elements in your investment thesis?
Yes, partnership is of course one of the important factors. We like to do repeat business also, not inventing the wheel from the beginning, but like to build on, as said, partnerships, building up trust, and then also repeating certain systematics. For instance, the guarantee cap model, which we've established with Radisson, was quite a sophisticated model, which we've been elaborating together. So it's of course makes sense to take benefit out of that and do not only one deal, but do multiple deals. And then of course, at the end of the day, it comes down to the asset and location itself. All these ground and main factors needs to be fine. We need the green the boxes to be ticked with a green arrow. So this is definitely, of course, something which we're looking at as well. Yeah.
Judah, you want to say something about that, or Philip?
But it's the question is also the amount of opportunities, because let's say investing in leases in hospitality is only a small part of the investment universe. You have to say, there's no precise figures, but let's say between 20 to 25% of investment volume are done through leases. So when you want to grow in different geographies, opportunities, obviously you need to take into account this point. The most important market is done through franchise or management agreement. It's been stated by Marriott or Radisson. And the amount of, let's say, either hotel operator or third-party manager that are able to do leases are not so huge in terms of universe. So that's why it's a limit when it comes to, let's say, build an investment strategy. And also that's why we decided to diversify a bit away from pure lease investment strategy to do more franchise and management. And the other reason why is that it's also a question of being jealous of the profit that is done in our hotel. So we say, look, can we do also ourselves the profit that the hotel operator are doing, being the tenant? And sometimes it's, in the hotel that you rent, half of the profit goes to the tenant and half of the profit goes to the hotel operator. So how can I grab the profit of the hotel operator? And the only way to do so is to flip to, let's say, management and franchise. So taking more risk, but let's say expanding in terms of return and also flexibility. And this is exactly what we've done last year when we decided with a huge portfolio that we are under a lease agreement with Accor Invest in France and Belgium. So we decided to take back the OpCo to do ourselves the profit and reposition ourselves all the hotel. Obviously, when you are alone owning an hotel, you don't have all this very tricky discussion that you mentioned, Andreas, of who is responsible of what? You are responsible of everything. So you can blame only yourself for
Yeah.
being bad or granted for being good. So it's easier, obviously. It's a different kind of team. It's a different kind of experience of risk. But it's also, I would say, more rewarding. So at the end, for us, the question is, in a risk-return approach, how much we want to do between those, let's say, quite institutional, resilient investment case, and what is the more value add? It's not only value add, but part that you want to put in your portfolio.
Philippe, are you willing or ready to grab that profitability that comes to the operator at Swiss Life?
No, for sure. We've done it already.
Okay.
We've done it already for very specific assets, but it's a question of how to grow and learn and where are the risks, and then having as you said the right people working on it. It's a very different business as an pure asset manager, fixed leases, more passive, and to managing it out yourself. It's a different way of thinking. So no, we do it. We're gonna do it more often, but so far we're still doing also mainly leases as well.
Andreas, are you moving toward that new movement Covivio initiated, grabbing the operation profitability, or more traditionally remaining an investor?
We are and we will be going on as investors. So we are not allowed German investment law to operate hotels ourselves. We can't have any employees on the payroll neither, and can't be dependent entirely of the success or unsuccess of the real estate. So therefore, it's a regulatory thing. Even though we do need to understand it, we can't be the
Andreas,
ones
your mic.
operating the hotel ourselves. So Tugal, maybe one day we ask you to operate a hotel for us. That could be an idea, yeah? We take a merit franchise.
So that means share profit with you?
Yeah.
Share profit with you, Andreas? No.
Well, yeah.
It starts to be a deal today at MIPIM. So Michel, Valerie, turns out that Union Investments might be a simpler partner for you, not grabbing too much. How do you adapt? Michel, you told a few minutes earlier that you are also there to work with your partner, working with them for 2 years, helping them, settling everything on, etc. So where is the frontier between I come and reach my partner's need and I keep the value for Marriott, I keep my job, what I know? What do you supply to your investor partners?
I think it's going back to what my partners have said in terms of flexibility. I think the old fixed lease, the times are over, in my opinion, and it goes two ways, right? They also discovered they could that the asset would be valuing much more for the landlord if they had a variable lease. So that's number one. Number two is you got to sit around the table and find, I'll use that word against the sweet spot where everybody benefits for the partnership, and that's how you can grow, right? So we bring top line power through Bonvoy, through a loyalty system or distribution or low cost of acquisition. And that's one of the best in the industry, if not the best, of course. I respect Valerie here, and that's really where we drive that. And if we had to set ourselves up in there and give everything in terms of being responsible for the maintenance, taking the bookkeeping, accounting implications of leases, we're not doing our job right, So, and then back to Andreas' point on being the employer, we have situations where actually we have found solutions to this. Where they can be done. In fact, we do have leases together indirectly with Union as well, and they work very well. We have actually a very profitable lease for both sides, as a matter of fact. So I think it's doable, and I think the good trend is that balance of risk is being distributed fairly again. After COVID certainly helped us. And also, I think another trend is that hotels are back into fashion more than ever. They're more a respectable and sort of privileged asset class today. And that's why you see a lot more owners interested to find those solutions and look at all the upsides and still mitigating the downside, right? So that's where we can come in and sit around the table and find solutions.
Does that mean, Philippe, Andreas, and well, Tugdual, you are hotels only, but that your companies being an investor are going to have hotel portfolio growing and go a little less into offices or real estate or Philippe, I see you.
No, for sure. I mean,
Yeah.
as you said, hotels today with probably logistic are the ones investors want to get into. With COVID, really helped the asset class, saying you have a business case for how resilient you can be with a very black swan event. So that's why when you allocate in real estate, which is still not back to where it was, you do tend to go more into hotels. And those investors who are willing to take that level of risk are more keen to having variable components, not having just pure fixed leases, which is the type of investors who now want to invest in real estate.
Yeah, I think it's really, we're having a renaissance of the hotel as investment target. And as Viput pointed out, we were having the best worst case scenario we could have with COVID, and it's back. And now hotel transactions last year in Europe was about 16% of the entire transaction volume in Europe, which is an all-time high for the last 15 to 20 years. So it's really, relatively speaking, of course, we're still coming from a bit lower levels in overall, in absolute numbers, but in relative numbers, hotel transactions are really, now it's at top levels. People are in search for hotel real estate, also for diversification. They see their upside. They see potentially good future. If you're looking at the forecast of WTTC, there is much more travel expected internationally, also from new countries like new countries in parentheses like India, where people, the growing middle class, people are more and more traveling internationally, intercontinentally. So this is definitely, so therefore that also contributes to filling up hotels. Then of course you need to see, how to deal with over tourism, but that could be different panel then, I would think.
Yeah, we're going to talk about that beginning of the afternoon, the investment climate. Tugdual, I know that Covivio Hotel is growing and growing, but within Covivio, where it stands?
But when it comes to, I would say, allocate capital, obviously Covivio is a good example of the way things are evolved. Historically, Covivio was mostly office investor with a strong footprint in specifically in Paris, France, and Milan and Italy, with a bit of also German exposure. Was more than 50% of the portfolio. Then Resi was 30%, and hotel was moving from 15% to 20%. Today, the objective is to have a balance between office, resi, and hotel, 1/3, 1/3, 1/3, which makes a big increase of our hotel exposure, or a big decrease in the office exposure, or both. Yeah, this is the way also things are evolving. Obviously, demand for offices, we all know that is a bit reducing or shrinking due to new ways of working, even if it's probably the end of this adjustment. And on the other side, new supplies continue to be there, new development of a new customer, as has been mentioned by Andreas, is coming. So we are in different, I would say, dynamic, and that's why also we adjust the allocation of capital to take that into account.
So Valérie, Michel, you have partners who are really ready to move on that topic of the hospitality. I've kept the best part for the end, being allocation of capex between each of you, operators, investors. How do you negotiate that? Who does what and why?
It's a good question. No, I think we have a very open and transparent discussion with our partners in that respect, and it eventually reflects in the totality and the holistic approach of the transaction. So capex contributions are possible, but then it's translated into the rent payable to the landlord. So there are various structures and various possibilities on the table. It needs to be a balanced transaction, and I think that's where Michel really highlighted something very important, that it needs to be a partnership that is very relevant to both partners, and we need to find a solution on how to get there. Transparency in that conversation is essential, and that has brought us to where we stand today.
In allocating capex, can you hear me? Yeah. In allocating capex, I think you need to look at the type of agreement you have on a lease agreement versus a management agreement. And I'll keep this fairly simple. Obviously, in the lease agreement, it's all stipulated by the lease contract, so it's pretty straightforward, or it's more straightforward than it used to be, I shall say, to Andrea's point, because it used to be very vague in the old days. But then again, it doesn't mean that you cannot form that partnership and find ways to change the lease, extend it, and find solutions that drive value on both sides, right, for both partners. Under a management agreement, we're always very keen to sit down with our landlords and find solutions that are, that give an ROI for the owner and for Marriott. So we will always do this, and that's what we love to do. It will eventually be better for the hotel. Now, every asset is different. It's a different story for a select service or a mid-scale brand than it is for a luxury brand, where you have usually much more flexibility to reposition a property, to change it in brand, to add restaurants or facilities and what have you. So, but on that side, I think we've shown over the years that we're very keen on working together on allocating of capex for your specific question. So
everything is about balanced. I see you nodding, Andreas, as an investor.
Yes, it's balanced, and it's always as my colleagues have pointed out, something individual. You individually agree. We usually have like demarcation lists where you've got the crosses for every item. Who is responsible for exchange, who is responsible for repair, renewal. So there are big discussions on these lists. But the good thing is, we then have transparency, and there are no bad surprises. And when it comes to the point of exchange of repair, you just look it up, and then you can ideally realize what has been pre-agreed.
Do you gentlemen want to add something on that? Or everything is on the same page? Everyone, not everything, sorry. In a few minutes, we are going to talk about one more thing, which is how the hospitality industry has actually inspired the office development. But do you, ladies and gentlemen, have questions for the panel that is here? Or has everything been covered and everything is clear? Yes, sir.
Good morning. I came late, so I apologize if I miss out anything. The question is, from the standpoint of an investor, when you look at purchasing a lease or investing in a lease, what cap rate do you look at, and what is the duration of the lease term that you would look at before you selecting it? Because this is not like a straightforward building. You lease it to Louis Vuitton for 20 years, you know what you're getting. Hotel is very volatile. Heaven forbid there's another COVID situation, then they're not operating. So there's certain risk factor there. How do you look at when you invest into it? And by the way, one more thing, if you would indulge me, how do you structure a lease of a hotel? It's very different than the general class of buildings.
So this actually calls a big
I
answer.
can start answering. Basically, because we have also the experience of investing in hotel and resi, so we have a lot of data and ways of looking at it or allocating. Because when I suggest an investment in hotel, obviously we have on the same board people from office and resi, and we challenge ourselves. So that's why it's interesting. Usually, when you look at the ranking of the yield of different asset class, hotel is on the top in terms of higher yield. I'm used to say that basically, let's say, same kind of occasion of prime office versus prime hotel, you can get between 50 to 75 bips higher, which kind of answer to what you're saying about volatility. Obviously, it's fair to say that an hotel lease is not the same as an office lease. So that's reward a bit of a premium. But on the other side, the big difference is that on offices, you have rent-free period, you have regular break option. You don't have that in hotel lease, or to a strict minimum. And I would say the longer the better in terms of lease duration, both in the interest of the landlord and most importantly of the hotel operator, because when the hotel operator is doing profit, he wants to be sure that he can renew the lease to not be kicking out of the premise. So that's the first thing. And then in terms of yield, it's fair to say that investing in hotels and underwriting an investment case is a bit more difficult than for offices. For offices, you have a lot of data for rent in different area, etc. In hotels, it's much more difficult because each case, each hotel operator, each positioning of hotel reward a different kind of rent per room, etc. And the way the hotel is operated, I can get the two extreme. We have today hotel operator that operate fully digital. There's no more or very limited people on site, 1 or 2 people on site. So you have higher profitability, so that deserve higher rent, rather than a standard hotel, I would say 3 or 4 star hotel, where you have lower, I would say, margin and then lower rent. So that's why it's there's no general approach. It's really a case-by-case investment. But on the yield, it's what I can say.
No, and maybe one main difference as well is in an office, your tenant is the premises are cost based. It's a cost for it. In a hotel, it's making money in it. So the very different way of looking and the partnership that you can get in a hotel is way different than in offices. So it makes sense to be a partner when you're both making money in the premise. When it's a pure office, it's a line, it's a cost on your P&L, or it's a debt on your balance sheet. So it's a way different way of looking at it.
What is the cap rates that you look at?
Depends. It really depends on location, type of asset, and I think I would maybe just answer the same way as the premium you get on a hotel compared to office is as I said 75 bips. That's more the way you look. Then afterwards, the range you can get can go up to 300 bips spread depending on the type of asset you're looking at.
I'm sorry, I'm not familiar with the 300 pips and 75. Coming from America, it's like we look at cap rates and the percentage of return.
No, so 200 bips means 2%. It's just, but we look at cap rate the same way.
Thank you.
We have another question in front.
In France, we have this typical fonds de commerce and mur walls versus business situation where I think a commercial lease is close between an office and a hotel because you're protected if you own the fonds de commerce. But by blending, as the industry is increasingly doing, by blending fixed lease and turnover rent or EBITDA rent, aren't we making it more difficult to value the business for the owner of the business, the fonds de commerce in France?
I would like to pass this question on to my francophone counterparts here, who could probably answer better. But I think it's really tricky, and particularly to define the value of fonds commerce is a challenge, as far as I understand. Yeah.
Also, for us being an international company, evaluating fonds de commerce is not a straightforward exercise. We are today, in some cases, the creator of the fonds de commerce. So we have some commercial leases on our balance sheet, and And often, in order to find a solution for conversion opportunities, we look at location gérance, which, from our point of view, circumvents the very long negotiation on the value of the fonds de commerce.
Tugdual being the
At
French
the end,
one.
we've done this exercise when it comes to negotiate with our tenant last year with Accor Invest. So I would say I'm not sure the differences in terms of lease structure add complexity. At the end, valuing a business is difficult, but if you take into account the lease, which is a fixed lease plus variable part, etc., all is you can put in a model. At the end, it's the most important part is what kind of turnover you can get and what is the GOP profitability that you can get. But after you put the rent, and for me, it's not adding complexity. At the beginning, valuing a fond de commerce is a complexity.
Well, thank you, everyone. We are going now to talk about one more thing. Thank you, Valérie, Tugdual, Andreas, Philippe, Michel.